Most fair value gap videos teach you what a fair value gap is. Very few explain why it works, and that's why most traders use it the wrong way. In this video, I'm not treating fair value gaps as a random setup. I'm showing you a structured framework based on how the market actually moves. This framework combines three powerful elements. First, a smart money behavior that repeats every day, the balance, imbalance, and rebalance cycle. This is the market mechanism behind fair value gaps. Second, Fibonacci ratios, introduced by Leonardo Fibonacci, to identify high-quality rebalances, not random pullbacks. And third, candlestick behavior, as taught by Munehisa Homma, to confirm whether the market is ready to move or not. When these three align, you're no longer guessing entries. You're trading with context, confirmation, and structure. If you've been using fair value gaps without consistency, this will change the way you see them. Before you can understand fair value gaps, you need to understand how the market actually moves. The market doesn't move randomly, it follows a simple and repetitive mechanism. That mechanism has three phases: balance, imbalance, rebalance. This cycle repeats every day, on every market, and on every time frame. Balance is when buyers and sellers agree on price. There is no urgency. Price moves slowly, often sideways. This is where the market is comfortable. Nothing special happens here. Imbalance occurs when one side suddenly takes control. Buyers overwhelm sellers, or sellers overwhelm buyers. Price accelerates. Candles become large. The move is fast and aggressive. This is where the market becomes inefficient. After a fast move, the market cannot continue indefinitely. Liquidity drops. Execution becomes unstable, so price slows down and retraces. Not to reverse the trend, but to rebalance. This is the market restoring efficiency before continuing. And this is the key point. A fair value gap is not the imbalance itself. It is the footprint the imbalance leaves behind. Fair value gaps don't cause price to move. They reveal where the market became imbalanced. So when you know how to correctly identify valid fair value gaps, you're not guessing entries anymore. You're identifying where the imbalance happened and then waiting patiently for the rebalance. A fair value gap forms when price moves aggressively in one direction. Instead of trading smoothly, the market accelerates so fast that not all price levels are traded properly. As a result, a gap appears between candles, showing an imbalance between buyers and sellers. This gap represents an area where orders were skipped. Liquidity was thin. The auction process was incomplete. Because of that imbalance, price often returns to this area later, not randomly, but as part of the market's rebalance process. When price revisits a fair value gap, the market is checking whether that level can be accepted or rejected. And that retest is where traders look for high probability opportunities, especially when the gap aligns with market structure and context. A fair value gap, by itself, is not an entry signal. It simply highlights where price moved too fast and where a rebalance is likely to occur. To identify a fair value gap, you need to focus on a three-candle sequence. Start by looking for a strong, impulsive move in one direction. This move represents the imbalance phase. Within that move, pay attention to three consecutive candles. The first candle, the second candle, which is usually large and aggressive, the third candle. Now here's the key condition. If the high of the first candle does not overlap with the low of the third candle, the space between those two prices forms a fair value gap. That area shows where price moved too fast and where trading activity was skipped. To mark it on your chart, simply draw a rectangle covering the high of the first candle, the low of the third candle. This highlighted zone is the fair value gap. The exact same logic applies to bearish setups, just in the opposite direction. You look for a strong bearish move and a gap where the low of the first candle does not overlap with the high of the third candle. One important rule to remember: if there is no clear gap between the first and third candle, then there is no fair value gap, no matter how large the middle candle is. Size alone does not make a fair value gap valid. Structure does. Now that you understand what a fair value gap is and why it exists, there's something critical you need to know. Not all fair value gaps are worth trading. The market creates many fair value gaps every day, but only a small number of them align properly with the market mechanism. That's why most traders fail with this concept. They mark every gap they see and expect it to work. In reality, fair value gaps must meet specific conditions to have a high probability of success. So in this section, I'm going to walk you through 4 criteria I personally use to filter fair value gaps. These criteria help you focus only on the gaps that make sense within the balance, imbalance, and rebalance cycle. If you skip this part, you'll keep taking low-quality setups. But if you understand these filters, you'll know exactly which fair value gaps to trade and which ones to ignore. Let's start with the first one. The fair value gap must be unmitigated. For a fair value gap to have a high probability of success, it must be unmitigated. Unmitigated simply means price has not returned to it yet. When a fair value gap first forms, it represents an area where the market moved too fast and left unfinished business behind. That imbalance has not been addressed. Once price comes back and trades into the gap, the market has already started the rebalance process, and from that moment on, the edge decreases. That's why the first retest is the most important one. If you see a fair value gap on the chart, the first thing you must check is this: has price already been there? If the answer is yes, then that fair value gap has already been mitigated, and it's no longer a high-quality opportunity. Here's an important point to remember. When price returns to an unmitigated fair value gap for the first time, it must respect the gap. If price retraces too deeply and closes through the gap, that tells you the imbalance has failed. At that point, the fair value gap is invalidated. Criterion number 2. The fair value gap must be significant in size. When you see multiple fair value gaps on the same setup, you should always prioritize the larger, more visible ones. Size matters because it reflects how aggressive the imbalance was. A large fair value gap forms when price moves with strong momentum and little resistance. That tells you one side of the market was clearly in control and the imbalance was meaningful, not temporary. Smaller fair value gaps, on the other hand, often form during weaker moves. They usually represent minor inefficiencies that can be filled quickly or ignored entirely by the market. Criterion number 3. Use fair value gaps based on their position in the move. When a strong move creates multiple fair value gaps, you should not trade all of them. Instead, you filter them based on where they are located within the move. If price is moving upward and several fair value gaps form along the way, focus on the fair value gaps located in the lower portion of the move. Avoid the fair value gaps formed near the highs. The reason is simple. During the rebalance, price is far more likely to retrace into the lower part of the move than to revisit the extreme highs. If price is moving downward and multiple fair value gaps appear, focus on the fair value gaps located in the upper portion of the move. Avoid the fair value gaps formed near the lows. Again, this aligns with how the market rebalances. The market doesn't rebalance by going to extremes. It looks for efficient prices. Fair value gaps positioned deeper in the move offer. More realistic retracements. Better risk to reward. Higher probability reactions. Criterion number 4. Avoid fair value gaps formed near major key levels. Not every fair value gap deserves your attention, even if it looks clean. One type of setup you should avoid is a fair value gap that forms too close to a major key level. Key levels represent areas where the market has already shown strong reactions in the past. They attract liquidity, hesitation, and opposing orders. Let's say you spot a bullish fair value gap forming during an upward move. If there is a major resistance level just above it, the market may react to that level before the fair value gap has any chance to work. Instead of continuing higher, price may stall, get rejected, or reverse entirely. When that happens, the fair value gap loses its edge, not because it was wrong, but because context was ignored. If a bearish fair value gap forms right above a strong support level, that support can absorb selling pressure and invalidate the setup. Now let me walk you through a practical rule. Before trading any fair value gap, always ask, is price running into a major key level or away from it? If the gap is forming into a key level, ignore it. If the gap is forming away from a key level, it has room to work. What you've learned so far is the foundation, and if you use it on its own, that's fine. You already understand fair value gaps better than most traders. But here's the truth. If you stop here, you'll still struggle to find high probability trades because fair value gaps by themselves are not enough. That's why most traders stay inconsistent. In this video, I'm going to show you the one type of fair value gap that actually matters, the one that consistently works when everything aligns. The best fair value gaps are not random. They respond to 4 key conditions. The fair value gaps that work best are the ones that form at or immediately after a break of structure. Hold the 50% or 61.8% Fibonacci retracement, where rebalancing is most likely. Show strong candlestick confirmation based on the principles of Munehisa Homma and align with the higher timeframe direction. When these elements come together, you're no longer trading fair value gaps. You're trading structure, timing, and confirmation all at once. Condition number 1. Fair value gaps that form after a break of structure. Fair value gaps that form after a break of structure are among the strongest. A break of structure tells you one simple thing: the market has committed to a direction. This is not hesitation, this is continuation. So what exactly is a break of structure? In an uptrend, a break of structure happens when price creates a high, pulls back, then pushes above that previous high. That previous high is the last level where sellers manage to stop price temporarily. When price breaks above it, buyers have clearly taken control. In a downtrend, the logic is the opposite. Price creates a low, pulls back, then breaks below that previous low. That confirms selling pressure. So why are fair value gaps after a break of structure so powerful? When price breaks structure, stop loss orders are triggered. Momentum increases, liquidity is released. This is where price moves fast and aggressively. If a fair value gap forms during or immediately after that break, it tells you the move was strong and decisive. That imbalance is not random. Later, when the market enters the rebalance phase, price is very likely to retrace into that fair value gap before continuing in the same direction. Condition number 2, the fair value gap must hold the 50% or 61.8% retracement. Let's walk through a clean example step by step. First, look at the market structure. You can clearly see that price was making higher lows, then it creates a strong bearish move and breaks below the previous low. That confirms a break of structure. This tells us the market has committed to the downside. Now focus on what happens during that break. As price breaks structure, it moves fast and aggressively. And right here, during that impulsive move, a fair value gap forms. You can see a clear 3-candle sequence where price skips levels. The first and third candle do not overlap. An imbalance is left behind. This fair value gap is the footprint of that imbalance. Now we bring in Fibonacci. When we use Fibonacci here, we're not predicting anything. We're simply measuring the move. We draw Fibonacci from the beginning of the impulsive move to the end of the move. Once it's on the chart, we don't overanalyze it. We check one thing. Does the fair value gap zone align with the 50% or the 61.8% level? If it does, we classify it as a golden fair value gap. As you can see, this fair value gap forms right after the break of structure, and it aligns perfectly with the 61.8% Fibonacci level, which qualifies it as a golden fair value gap. Now look at what happens next. Price retraces back into the fair value gap, the imbalance is addressed, and then the market continues lower. This is exactly the behavior we're looking for. But is this enough on its own? No, it's not. Even when a fair value gap forms after a break of structure and aligns with the 50% or 61.8% Fibonacci level, we still don't enter immediately. We wait for the retracement and we observe how the market reacts to the zone. That reaction is what gives us confirmation. And this is where Munehisa Homma's work becomes essential. If you're not familiar with Munehisa Homma, he was one of the first traders to study price behavior through candlesticks, long before modern markets existed. His work showed that price reflects human behavior: indecision, acceptance, rejection, and momentum. Candlestick patterns such as doji, engulfing patterns, harami, and other reversal signals were originally developed to read market intention, not to predict outcomes. Now, we're not trading the market the same way Homma did. Markets have evolved, but the behavior behind price has not. So instead of using candlestick patterns on their own, we use them as confirmation signals when price reacts inside a high-quality fair value gap. When you combine the balance, imbalance, and rebalance market mechanism, Fibonacci to validate the fair value gap, and candlestick behavior to confirm market intention, you stop guessing. You start trading with context, timing, and confirmation. And that's what separates structured traders from struggling retail traders chasing setups. Let's look at a clear example on the chart. First, notice the overall structure. The market is clearly moving higher, which tells us buyers are in control. Now focus on this point here. Price breaks above the previous high, which confirms a break of structure. This tells us the market has committed to the upside. Next, look at what happens during that break. Price moves aggressively, and during this impulsive move, a fair value gap forms. This gap is the footprint of the imbalance created by that strong push higher. Now we validate the fair value gap with Fibonacci. We draw Fibonacci from the beginning of the impulsive move to the end of it. As you can see, the fair value gap aligns perfectly with the 50% and 60.8% Fibonacci levels. Because the fair value gap holds these levels, we classify it as a high-quality fair value gap. At this stage, we still do nothing. We wait. Price retraces back into the fair value gap, and now we watch how the market reacts to the zone. This is where candlestick behavior becomes important. Inside the fair value gap, a clear Tonkachi candlestick forms. According to the principles introduced by Munehisa Homma, This type of candle signals rejection and buying pressure after a pullback. This tells us the market is accepting higher prices again. Here's how to trade this setup. Entry at the close of the Tonkatchi candlestick. Stop loss placed just below the resistance level that becomes support. Target the next logical level in the trend. Now look at what happens next. Price moves away from the fair value gap, respects the structure, and continues higher, reaching the target. This trade worked not because of a candlestick alone, and not because of a fair value gap alone. It worked because structure was broken, the fair value gap was validated by Fibonacci, and candlestick behavior confirmed the entry. That's how you trade with context, confirmation, and structure. But is this enough on its own? No, it's not. No matter how clean the fair value gap is, no matter how perfect the Fibonacci alignment is, and no matter how strong the candlestick confirmation looks, you must trade with higher time frame context. This is where top-down analysis comes in. Your trade setup must be aligned with the higher time frame direction. If the higher time frame is bullish, you look only for long setups on the lower time frame. If the higher time frame is bearish, you look only for short setups. This simple rule alone filters out a huge number of losing trades. Use a 2-time frame structure. If you trade on the 5-minute or 15-minute chart, use the 1-hour chart as your higher time frame. If you trade on the 1-hour chart, use the daily chart as your higher time frame. If you trade on the 4-hour chart, use the weekly chart as your higher time frame. That's it. No need to overcomplicate it. By following this 2-time frame approach, every trade is taken with the dominant structure. Your entries become more selective, your charts stay clean, and your decisions are based on structure, not guesswork. If this video helped you learn how to trade fair value gaps, make sure to like the video, subscribe, and hit the notification bell so you don't miss future uploads. Thank you for watching, and I'll see you in the next video.